Hello and welcome to another one of our Macro Mondays, a podcast where we take current events and apply them to people that are living in New Zealand and Australia. We do just generally cover global macro events and global trends as they're going on to apply them to finances and the economy. First of all, how could we talk about this without mentioning it? But the interesting and controversial Olympic opening ceremony, which has resulted in a lot of upheaval on the internet, as well as sponsors of the Olympics pulling their funding or their advertising from the event. It's a really interesting outcome. We saw a lot of it over the last couple of years where certain behavior online has resulted in businesses or organizations losing income or sponsorship or funding due to their activities. I don't think we would have expected this to kind of unfold like it has, but it seems like it wasn't received well in this instance, and so much so that actually they are now going to lose some advertising revenue, and potentially other companies may pull after this too. So it'll be really interesting to see how it pans out. Obviously, the Olympics are not a public company or anything, so there's no stock prices that will likely be impacted here, but just really interesting to see how the internet has this way now of creating these mimetic events where ultimately the pressure of the chitter chatter online can create such profound and quick movements. Obviously, this telecom company, C-Spire, didn't want to be associated with the Olympics after what they had done. But yeah, it'll be an interesting topic to see how it unfolds out of just interest more than anything, keeping an eye on it. But let's get into some more kind of finance and macro related activities that are kind of more traditionally macroeconomic. I do think, however, though, events like what has happened with the Olympics that are relatively mimetic and reflexive in nature should be discussed and considered when thinking about markets and the investing world, because so much of investing is driven by sentiment and mimetic behavior. Anyway, moving on. So this week we wanted to kind of observe some of the data coming out of hourly wage growth in New Zealand and the US. So we wanted to do that here. What you can see is the percentage growth of hourly wages is basically starting to tone down now. So you can see a clear slowdown in the wages. Now, if you were to then go ahead and break this down by sector, I did notice that the sectors that saw the most growth was healthcare and construction. And that would most likely explain why the female hourly wages are still growing quite rapidly, because there was a heavy amount of hiring in the healthcare space. This isn't different from the US. The US is also starting to tone down when it comes to the hourly wage growth. Now, we measure it slightly different from the US and New Zealand, but the story is relatively similar. They're combining genders, so they're coming up with something in the middle of what we have. You notice that they're not actually slowing down quite as fast as we are. However, they are slowing down. So relatively similar here, and there's a theme here between New Zealand and the US. The reason the US is so important is because we hold so many investments in the US market. So the US economy becomes this really important part of pretty much anyone in the West's investment accounts, because people in the West hold the largest tech companies in the world. So what happens in the US directly affects KiwiSaver balances, investment accounts, managed funds, all sorts of things. So really interesting to watch both. Unfortunately, because we are so connected to the US, we have to look at the US and see what's going on. But I think the conclusion here is that the globe is slowing, specifically the West is slowing, and New Zealand is slowing what seems to be a little bit faster than the US. The second topic of the day is big tech Capex splurge that we are seeing in AI. So the amount of spending that's going on to develop clusters for AI training, to deliver services for other cloud consumers that want to train AI models or run AI models. So this is Microsoft, Google, Amazon, Meta, all spending lots of money on AI and these AI clusters that are able to train these large language models. So I have two charts today, one being the speed of which Microsoft is ramping up their CapEx spend. And the important thing to note here is that CapEx is often cyclical. So you don't typically see continuous outlays of capital to build out for new technology. Typically what happens is it ramps up very, very quickly and then falls off as most of the gains are realized. And essentially it's a forecasting issue. Typically we get excited about new technologies and then we don't quite achieve the forecast as fast as we expect, although the eventual outcome may be that we get it right or somewhere in the vicinity. But typically when you get very excited about new industry and a new opportunity, and Microsoft and Google and Meta, they're all seeing this as two opportunities. One, to have an edge from others, from their competitors, but two, also potential revenue streams through their cloud businesses. So Amazon Web Services, Azure for Microsoft, and then the Google's cloud business as well. On the other hand, you have Meta, which have made an open source model, and we're not really sure how they're going to monetize this at all yet. So if you remember back to when Meta was formerly known as Facebook officially, but they changed their name to Meta, that was all around the metaverse. And you saw back then they actually had a huge CapEx spend and then had to pull it back because they weren't going to realize the revenues fast enough. So if these companies continue to spend on CapEx but don't find revenues, it could be a risk to their stock prices and the excitement around AI. And remember that Nvidia and the other associated semiconductor names are going to be the ones receiving all of this revenue that's being subsequently obviously spent by these hyperscalers. This is the CapEx spend now across your four major companies that are doing this CapEx spend. You can see that Google and Microsoft are the most aggressive generally, and then Meta has been quite active recently. If you think about 2021 and 2022, a lot of that was the spend that they had planned for the metaverse in that year, and that's why there's such a big jump. They then moved back in 2023 and toned down some of their spending, but we imagine that in 2024 it will have ramped up again. But just a really important note that these things are cyclical. So these huge spending sprees that these companies are taking on are not typical and often will end up scaling back eventually. Okay, so another interesting piece of data here was delinquencies for credit cards in the US from 2019 to basically today. You can see that basically through COVID, because of all the stimulus that happened, very few people were defaulting on their credit cards. So most people could pay their credit card balances and were not defaulting. There was not high delinquencies. But what we've seen from 2022 onwards is this quite sharp and consistent trend upwards as more and more people lose their savings that they'd built up through the pandemic with the inflation that we've seen, and now potentially less income coming in as people potentially lose their jobs. And we do have a bit of a recession. This basically does often result in higher delinquencies. So just another really important thing to note when it comes to the business cycle. People often think business cycles are aligned with asset prices. That is not the case. Asset prices may be extremely high while you have high delinquencies, because in the short term, price is dictated by momentum and narrative and sentiment. So just to bear in mind that even if there are poor economic indicators, it doesn't necessarily mean that stocks go down, at least in the short term, but it can be an interesting guiding force. And often history kind of would say that the stock market specifically, but riskier assets, are the last to realize that we would be in a recession. So you often see those fall last. Different parts of the stock market can also go up and down in different timings. So really important to look at some of these more traditional industries like retail and transportation. They have been having quite a difficult time in the last period, and that's indicative of this weaker consumer. That does ultimately mean that yields go back down. What you see is since at the end of 2022, early 2023, we've been in this kind of 4 to 5% range on the year yield, which could say, oh, well, that's potentially a new normal. And I wouldn't rule that out. We definitely haven't seen disinflation yet. However, it does seem to me, with all the other data we have around delinquencies and the slumming economy, that rates are likely to fall unless there were some idiosyncratic reasons why inflation was very sticky, which would basically mean that yields don't fall at least as far, but it may mean that there's a sense of a new normal in terms of the average 2-year rate. And maybe that drops to the kind of 2.8 to 3.2 range. It really depends if there was like an accelerated slowdown in economic activity. But the trend here says that from a US perspective, over the last couple of years, you don't have a great trend in terms of actually seeing it drop, but when it drops, it will drop sharply. And that's actually kind of what you saw in New Zealand recently. So this is a 1-year chart of the 2-year bond yield. You saw that right up until the end of July, it was almost at 5%. And now we're looking at something around 4.3, maybe 4.4. So dramatic move in bond yields there. That means that the bond price will go up. And it also could mean that the New Zealand dollar becomes weaker. I think there's a really interesting piece at work here, something that I definitely spend a lot of time thinking about, which is how does the US dollar and NZ dollar play together here. And what you can see is that the 2-year yield has dropped dramatically with the New Zealand dollar, which could result in yields continuing to drop much faster, which would be very challenging for the New Zealand dollar, which could, as a consequence, mean that the US dollar is stronger and we have some kind of sticky service inflation issues and potentially cost of living crisis issues when it comes to New Zealand, because essentially our subscriptions that we consume from the US and other services that we have to essentially buy in US dollars will remain more expensive relative to the New Zealand dollar. So I don't really like that dynamic, but it's something that we might have to deal with. I also believe that there's potentially a little bit of a problem for the New Zealand central bank, where they won't really want to lower rates until the US lowers rates, just because it will affect the New Zealand dollar, and that has trickle-on effects. In an ideal world, I think from the New Zealand central bank perspective, is they will be thinking, if the US drops rates, that definitely gives us a green light, because we already really want to drop rates, but perhaps they're holding off because they're a little bit concerned around the strength of the dollar, which I think is a valid concern, and I would be thinking about it if I was a central banker. So what's the TLDR here? The TLDR is simply that things are slowing down, certain asset prices are historically high, and other asset prices are coming down quite quickly. An example being the US housing market and the New Zealand housing market, both moving down sharply and quite quickly. And then if you look at IPOs that have come out since kind of that COVID era, many of them are still down 90+%. Small and mid caps have also not performed too well in this up until recently. And then, like I mentioned before, transportation and retail industry not doing well either. So there is a slowdown, but once we've finished with the slowdown, we can get back into a more normal environment. And I think that's really what we're trying to find out here. It's important to kind of stay positive, because these sort of things happen. Economies are cyclical in nature, and if you ever get a period of time where, for example, a lot of money printing was to distort the market, it's going to potentially take years to solve it. But if you're able to work on your own income, get it as high as you can, and then have excess savings, you can find some great opportunities to have long-term gains. So I often think of these volatile times as an opportunity to research and find interesting assets that I could potentially invest in at attractive prices. So the good news is it looks like yields are coming down, and another more long-term good news, which I kind of think about a lot, is perhaps asset prices will eventually become appealing and I could get aggressive. Anyway, as always, none of this is financial advice, just for entertainment purposes only, and none of what we have discussed in this podcast buy, sell, or hold recommendations on any specific assets or sectors. We hope to see you again soon, and we'll be back next week with another episode of Macro Monday. We hope you enjoyed it, and once again, have a great week.